Okay, so imagine I somehow get handed the financial statements of the United States. Not a company, not a bank, not a giant corporation, the entire country. And the first thing I notice is that the numbers barely feel real. The American economy generates tens of trillions of dollars in economic activity every year. The federal government collects $5.23 trillion in taxes and other revenue. Then it spends $7.01 trillion. That immediately gives me a problem. Because if I were looking at a normal business and I saw $5.23 trillion coming in while $7.01 trillion was going out, I would ask one simple question: where does the missing $1.78 trillion come from? And that question is where the economics of running the United States really begins. At first glance, America looks unbelievably rich, and it is, but being a rich country and having a government with unlimited money are two completely different things. When I hear that the United States has an economy worth tens of trillions of dollars, it is tempting to imagine all of that money sitting somewhere in Washington like a gigantic bank account. But that is not what GDP means. That money is moving through millions of households and businesses. I earn a salary, I buy groceries, I pay rent or a mortgage. A restaurant sells dinner, a hospital charges for treatment, a software company sells subscriptions, a factory produces equipment, a bank issues a loan, a farmer sells crops. All of that becomes part of the country's economic activity. The federal government only captures a portion of it, mostly through taxes. So if I want to understand what it actually costs to run the United States, I first need to understand how Washington gets its money. The biggest source is individual income taxes. Millions of workers earn wages, salaries, bonuses, and other taxable income, and a portion flows to the federal government. Then there are payroll taxes, which help finance programs such as Social Security and Medicare. Then come corporate income taxes, customs duties, excise taxes, fees, and smaller revenue streams. Put everything together, and $5.23 trillion can flow into the federal government over a year. That is an extraordinary amount of money. If I spent $1 million every single day, it would still take me more than 14,000 years to spend $5.23 trillion. And somehow, it is still not enough, because now I have to look at the other side of the ledger. Where does all that money go? The easiest mistake I could make would be to imagine that most federal spending disappears into politicians or a few giant projects, but the biggest obligations are built much deeper into the system. Social Security sends money to tens of millions of Americans. Medicare helps finance healthcare for older Americans and certain other eligible people. Medicaid supports healthcare for lower-income households through a federal-state system. Then I have defense, veterans programs, federal salaries, transportation, infrastructure, education, scientific research, law enforcement, agriculture, security, and thousands of other programs. And there is one more category that becomes more important every year: interest on the national debt. This is where the first major contradiction appears. The United States is not spending trillions because somebody in Washington suddenly decides to buy something expensive. A huge portion of the budget is tied to obligations that already exist. People are already retired. Medical bills are already being generated. Federal workers already have salaries. Military personnel are already stationed around the world. Contracts are already signed. Roads, bridges, courts, agencies, and public systems already require maintenance. The government is not starting from zero every January. The machine is already running, and keeping it running is expensive. And that is where the big problem begins. The money coming in is already smaller than the money going out. So now I have a federal government spending $7.01 trillion a year, collecting $5.23 trillion, and leaving a gap of $1.78 trillion. That gap has to be financed. And before I get to the debt, I need to look at one of the most expensive systems inside the entire budget: the U.S. military. When I think about military spending, it is easy to picture fighter jets, aircraft carriers, missiles, and tanks. But financially, that is only the visible surface. What I am really looking at is a massive operating system. I have salaries for personnel, housing, healthcare, pensions, training, fuel, maintenance, logistics, cybersecurity, intelligence, research, construction, ammunition, bases inside the United States and across the world. A modern fighter jet does not cost money only when I buy it. It costs money every year I keep it flying. The same is true for ships, vehicles, helicopters, satellites, and military bases. So the military is not one giant purchase. It is a permanent stream of operating expenses. But defense is only one part of the problem. The larger issue is what happens when total federal spending stays above federal revenue. If I collect $5.23 trillion and spend $7.01 trillion, I still need $1.78 trillion from somewhere, so the Treasury borrows it. It does that by issuing Treasury bills, notes, and bonds. In simple terms, I am selling promises. An investor gives the U.S. government money today. In exchange, the government promises to repay that money later, usually with interest. Banks buy treasuries, pension funds buy them, investment funds buy them, insurance companies buy them, foreign investors and governments buy them. Even parts of the U.S. government hold treasury securities. Why? Every new bond creates an obligation, and when old debt matures, the government can issue new debt to refinance it while borrowing more to cover the latest deficit. That is how the total grows. Year after year, deficit after deficit, federal debt builds until the number stands at about $39.8 trillion. Now, this is where I have to avoid another bad comparison. Federal debt is not the same as my credit card balance. A household has limited income, a limited lifespan, and no ability to issue the currency its debts are denominated in. The U.S. government is different. It has a huge tax base, access to global capital markets, and debt issued in dollars. That gives it far more flexibility than a normal household. But flexibility is not immunity, because the debt has a carrying cost, interest. Imagine I owe $1 million at 2%. That costs me $20,000 a year. At 5%, the exact same debt costs me $50,000. Nothing about the original loan changed. Only the price of carrying it did. Now scale that idea from $1 million to tens of trillions of dollars. That is why net federal interest costs totaled about $970 billion in fiscal year 2025. At that point, interest is no longer background noise. It is one of the largest claims on the budget, and this creates the second major contradiction. Borrowing helps the United States cover today's shortfall, but the more I borrow today, the more of tomorrow's tax revenue may have to be used just to service yesterday's decisions. The debt does not have to cause a sudden collapse to become a serious problem. It can squeeze the budget slowly. More money toward interest can mean less flexibility for infrastructure, research, defense, healthcare, or tax relief. And now I can see the loop. The government runs a deficit. The Treasury borrows. The debt grows. Interest costs rise. Higher interest costs increase future spending. And if revenue does not rise fast enough, that can create another deficit requiring even more borrowing. The machine keeps running, but the price of keeping it running gets heavier. And that brings me to the next question. If Washington is borrowing trillions and spending trillions, where do the tens of trillions in the American economy itself actually come from? If the federal government collects around $5 trillion, but the American economy produces tens of trillions of dollars in activity, then I need to separate two ideas that are constantly confused. The federal budget is not the U.S. economy, GDP is. And GDP is not a pile of money sitting in one account. It is a measurement of economic activity happening across the country. Every time I buy groceries, pay for insurance, rent an apartment, repair a car, visit a doctor, or subscribe to software, I am participating in that flow. Now multiply that by millions of people, then add millions of businesses. That is where the scale comes from. Consumer spending is one of the biggest engines in the system. Households spend money on housing, food, transportation, healthcare, entertainment, education, and travel. Then there are services, technology, finance, healthcare, manufacturing, energy, agriculture, and millions of small businesses all pushing money through the system at the same time. To make this easier, I imagine one ordinary person. I will call him Jake. Jake lives in Texas. He earns a salary every month. Part of that salary goes to taxes. Then he pays his mortgage, buys groceries, pays electricity, internet, car insurance, fuel, and healthcare costs. Individually, none of those transactions looks important, but Jake is not alone. When tens of millions of households make similar decisions at the same time, their behavior becomes one of the strongest forces in the economy. If people feel confident, they tend to spend more. Businesses see stronger sales. Retailers order more inventory. Factories increase production. Companies hire more workers. Banks make more loans. Workers earn more income. And the government often collects more tax revenue. That is the positive loop. Imagine Jake becomes worried about his job. He stops eating out. He delays buying a new truck. He cancels a vacation. He pays down his credit card instead of spending. But if millions of people do it together, the consequences spread quickly. Restaurants lose sales, retailers move less inventory, car dealers sell fewer vehicles, factories receive fewer orders, businesses slow hiring, some cut hours or jobs. Eventually, tax revenue can weaken too. This is why consumer spending matters so much. It is powered by millions of private decisions happening every day. And there is another important reversal here. A country can have an enormous GDP without the government owning that output. If a business sells $10 million worth of products, that does not mean Washington receives $10 million. The business uses that revenue to pay workers, suppliers, rent, interest, equipment, taxes, and eventually profit. The government captures only a fraction through the tax system. That is why a nation can generate tens of trillions of dollars in annual economic activity while the federal government collects only a portion of it. GDP measures the size of the economic engine. Federal revenue measures how much of that engine flows into Washington. And once I understand that, something else becomes clear. The entire system depends on money continuing to move. Consumers need income, businesses need customers, workers need jobs, banks need borrowers who can repay them, investors need confidence. The government needs taxable activity. If households pull back, businesses feel it. If businesses cut investment, workers feel it. If workers lose income, consumer spending weakens further. And if the cycle slows, government finances can weaken at exactly the moment public spending is needed most. But there is still one piece connecting all of these flows: credit. Because households, companies, investors, and even the federal government do not operate only with money they already have. They borrow. And once I follow that borrowed money, I end up at the center of the American financial system: the banks, the Federal Reserve, interest rates, and the dollar itself. Once I follow credit through the American economy, I arrive at the infrastructure connecting almost everything else: banks. At the simplest level, banks take deposits and make loans. I put money into an account. The bank uses its balance sheet to lend to households and businesses. A family borrows for a mortgage. A driver finances a car. A small business takes a loan to buy equipment. A corporation borrows to build a factory. Credit allows spending and investment to happen before all of the cash has been earned. That can accelerate growth. That is why credit is not a side story. It is one of the main engines underneath growth. It can also create risk, because borrowed money always comes with a price: interest. And in the United States, one institution has enormous influence over that price: the Federal Reserve. The Fed does not directly set every mortgage, credit card, or business loan rate, but through monetary policy, it influences borrowing costs across the system. When rates rise, I feel it almost everywhere. A mortgage becomes more expensive. A car payment becomes more expensive. Credit card balances become harder to carry. A business loan costs more. A company considering a new warehouse may suddenly decide the project no longer makes financial sense. That is how one Fed decision can slow activity far beyond Wall Street. Now reverse it. When financial conditions loosen and borrowing becomes cheaper, households can refinance, companies can invest, and consumers can spend more easily. Credit expands, the economy can accelerate, but there is no free version of this system. Cheap money can encourage too much borrowing. Expensive money can weaken spending, and American households already carry enormous debt, including about $1.25 trillion in credit card balances in the first quarter of 2026. That matters because credit cards are some of the most expensive debt many households use. If I carry a balance month after month, part of my future income is already committed before I earn it. I spend less at restaurants. I delay replacing my car. I cancel purchases. The effect spreads back into businesses. But the financial system does not stop at the U.S. border. America imports enormous quantities of goods and exports services, technology, machinery, energy, agricultural products, aircraft, and many other things. And underneath much of that activity is the U.S. dollar. The dollar is used far beyond American households and companies. It is held by central banks, used in trade, borrowed by corporations, and exchanged globally. That gives the United States an unusual position. The same currency used for groceries in Ohio can also settle transactions thousands of miles away. Then there is the treasury market. Investors around the world buy U.S. government debt. Banks hold treasuries. Funds hold them. Foreign governments and institutions hold them. That connects federal borrowing directly to global finance. If the Federal Reserve raises rates, a family in Arizona may face a more expensive mortgage. A company in California may pay more to finance expansion. A bank may change how aggressively it lends. Treasury yields may rise. Global investors may shift money. Exchange rates can move. One decision can travel through the system in multiple directions at once. Banks connect savers to borrowers. Credit moves spending through time. The Federal Reserve influences the price of that credit. The dollar connects domestic activity to the world. Treasuries connect federal borrowing to global investors. And all of it depends on confidence that promises will be honored, debts will be paid, banks will function, and dollars will still be accepted tomorrow. That word confidence matters almost as much as the money itself. Because once confidence weakens, even a huge financial system can become unstable. And that brings me to the final question. What actually keeps this machine running, and what could break it? At this point, I can finally see the entire machine. The United States can produce tens of trillions of dollars in economic activity, collect trillions in taxes, spend even more, borrow the difference, and still keep functioning. But that does not mean the money is sitting in one giant national bank account. GDP measures economic activity across the country. Federal revenue is the portion the government captures through taxes. Federal spending is what Washington is committed to paying out. When spending is larger than revenue, the gap becomes borrowing. That is how I can have a massive economy, trillions in tax revenue, and still run a $1.78 trillion federal deficit in fiscal year 2025. Now I can see what keeps the system alive. Movement. People earn, people spend, businesses sell. Workers get paid, banks lend, investors buy assets, the government collects taxes, the Treasury sells debt. In a strong environment, this works well. If employment is high, households have income. If households keep spending, businesses generate revenue. If businesses generate revenue, they hire, invest, and pay taxes. But now I need to look at the other side. Suppose inflation rises. The Federal Reserve may keep interest rates higher. Mortgages cost more. Car loans cost more. Credit card balances become harder to carry. Businesses face more expensive financing. Some expansion plans get canceled. Some households reduce spending. Then imagine unemployment starts rising. Fewer people have stable income. Consumer spending weakens. Retailers sell less. Companies slow hiring. Some cut jobs. And tax revenue can weaken at exactly the wrong moment. Because during a downturn, government spending does not automatically fall. Healthcare and retirement obligations continue. Defense costs continue. Federal salaries continue. Interest on the national debt still has to be paid. That creates one of the most important reversals in the system. When households and businesses become weaker, the federal government may need to spend more while collecting less. The deficit can widen precisely when the economy is already under pressure. And then there is federal debt. Debt itself does not automatically destroy the system. The real question is the cost of carrying it. If interest rates stay high while debt keeps growing, more federal revenue can be absorbed by interest. That does not mean the government runs out of dollars. It means the budget becomes less flexible. So what could actually break the machine? Not one dramatic number by itself. The greater risk is several weaknesses reinforcing each other. High inflation can produce expensive credit. Expensive credit can weaken spending. Weak spending can hurt businesses. Business weakness can reduce hiring. Lower employment can reduce tax revenue. Lower revenue can increase deficits. But there is also an optimistic version. If productivity rises, businesses grow, wages expand, consumers remain resilient, and inflation stays controlled, the economy can grow faster than many of its pressures. Tax revenue can rise. Debt can become easier to carry relative to the size of the economy. That is why I do not think the real story of the United States is that it is simply rich or simply indebted. The real story is that it is a network of obligations. Taxes support spending. Borrowing fills the gaps. Banks create credit. The Federal Reserve influences its price. Consumers drive demand. So when I ask what it costs to run the United States, the answer is not just $7.01 trillion. The real cost is maintaining a system large enough, productive enough, and trusted enough to keep those trillions moving. Because the United States is not a giant vault full of money. It is a constantly moving financial machine. And once I understand that, the numbers stop looking like isolated trillions. They become what they really are. Promises, payments, risks, and decisions repeated every day.